The topic of this one is cost of capital and raising capital. These are two related topics, but different topics, but they're both Part 2, Section B topics. And so here we've got a question that's going to talk about the cost of capital. We've got some calculations connected to this and also some written things about the different sources of financing that a company has available to them. The company is Mednovation, and we'll go ahead and start, as always, by reading the information. Mednovation has developed a medical device to be marketed to medical facilities. The board of directors recently approved the proposal to upgrade existing production equipment and facilities for the new product. The project calls for extra financing either through debt or equity. In order to make a proper financing decision, management is interested in measuring the overall cost of capital through the following possible instruments. Okay, we've got a few choices here. First, issue common stock. Common stock is currently trading at, which means they've issued stock before. Common stock is currently trading at $21 per share. The firm is expected to pay cash dividends of $3.60 per share next year and will continue to remain at that same payout level. The flotation costs are expected to be $3 per share, and the stock price is expected to rise to $22 per share. Okay, so that's one option. Second is to issue preferred stock. Mednovation has $150 par value preferred stock with a current market price of $120 a share. The company currently pays an annual dividend of $20 per share. And third, we could issue bonds. Newly issued 20-year bonds can be sold at a par value of $1,000 with a 15% coupon rate. And the last piece of information, the firm has a 40% marginal income tax rate. Okay, we'll need that, obviously, if we're talking about the bonds, because that interest on the bonds is tax deductible. So that's all of the information. We have 5 requirements. The first, define and explain the concept of cost of capital. Okay, it's going to be a written answer. Second, calculate the cost of capital for Mednovation raised through common stock, preferred stock, and debt. Show your calculations for each instrument. So we're going to calculate the cost of common stock. We're going to calculate the cost of preferred stock and also the cost of the debt. The third requirement, identify and describe one advantage and one disadvantage to Mednovation of raising capital through common stock, preferred stock, and debt, respectively. So, one advantage and one disadvantage for each of those 3 methods that we have available to us. Fourth, calculate Mednovation's weighted average cost of capital, assuming the company decided to raise capital using the following weights of 25% common stock, 30% preferred stock, and 45% bonds. Show your calculation. And finally, define and explain the 2 types of public offering. Which type of offering can Mednovation use to raise capital through common stock? So we've got, looks like 2 requirements here that are going to have numbers, and 3 that are going to be written responses. But we'll go ahead and we start with the first one, define and explain the concept of cost of capital. Again, different ways to define it and explain it, but what they gave is cost of capital refers to the opportunity cost of using capital. A company's cost of capital is a composite of the costs of various sources of funds comprising a company's capital structure. It is the minimum rate of return that must be earned on new investments that will not dilute the interests of the shareholders. Okay? I like this. It talks about a composite of the different sources of capital based on the company's capital structure. Okay? Some good terms there to have in the cost of capital for the company. Now, the second requirement is where we need to calculate the cost of capital for Mednovation through each of the 3 methods, and we need to show our calculations. Well, we'll start by calculating common stock, and what we have here in green is simply the information from the question itself, just so we can see that here and work with it. Common stock is currently trading at $21 per share. The firm is expected to pay cash dividends of $3.60 per share next year and will continue to remain at the same payout level. What that tells us is that the dividend is expected to be $3.60 next year, and $3.60 the year after that, and $3.60 the year after that, and $3.60 the year after that, which is another way of saying that there's no growth to the dividend. There is no growth to the dividend, and so we don't need to worry about a dividend growth model to calculate our cost of common stock. The flotation costs are expected to be $3 per share, which is relevant because we're issuing new stock. We've already issued stock. We have stock that's out there in the marketplace, but this is going to be a new issuance of stock. And the stock price is expected to rise to $22 per share, which, if we think about it, we don't care about. We can cross that out, really, because we don't use anything with an expected value of the share to make our calculation. So the cost of it's going to be the annual dividend divided by the proceeds from the common share. That's it. Okay, what is the dividend? And how much are we going to get from the issuance of a share? Because remember, the dividend's not growing, so we don't have to worry about a growth rate in there. So we know that the dividend is going to be $3.60, and we know that, well, we can calculate very easily. We're going to get $18 in total from a share. That's the proceeds. And so the cost of our common stock is 20%, $3.60 of the dividend divided by the $18 net proceeds from the issuance of that common share. So, cost of the common stock, 20%. We now can turn our attention to preferred stock. Again, the information that we have $150 par value stock with a current market price of $120, and it pays a dividend of $20 per share. Well, the cost of our preferred stock is the annual dividend divided by that market price of a preferred share. This is fundamentally the same as it was for the common share. We don't have any flotation costs here. And so the dividend's not growing. And so we have a $20 dividend, $120 market price of a preferred share. So the cost of our preferred share is 16.7%, a little bit less than that 20% that we had as the cost of our common share. Now we need to keep going. There were 3 of these. The third is the debt. The information is newly issued 20-year bonds can be sold at a par value of $1,000 with a 15% coupon rate. Well, we know that the interest on the debt is tax deductible. And so the cost of the debt to the company is going to be that pre-tax cost minus the effective taxes. So our formula, the cost of the debt is the cost pre-tax divided by 1 minus the tax rate. We had the tax rate of 40%. Remember, that was given to us there at the beginning. And so the 15% coupon rate multiplied by 1 minus the 40% tax rate gives us a 9% cost of debt. 20% common stock, 16.7% preferred stock, and 9% is the cost of debt. So that's one of our 2 calculation requirements. Okay, we've got another one coming up here in just a bit, but before that we have the third requirement. Identify and describe one advantage and one disadvantage to Mednovation of raising capital through common stock, preferred stock, and debt, respectively. Okay, so we need to have 6 things here in total, one advantage and one disadvantage for each of the 3 forms of capital that they're considering. Again, the answer doesn't have to be like this. There's multiple advantages and disadvantages you can choose from, but this is what they gave as the answer. The benefit of raising cash in the form of equity and stock offerings is that it provides a wider range of potential cash inflow. By offering the public the ability to invest in the company, Mednovation has more potential opportunities for cash inflow than from banks offering loans. Just there's a larger capital pool, is what this is saying. It's not the most concise way of saying it, but instead of looking at just banks, we're opening it up to every potential investor in the world. The ease of raising capital also comes with the disadvantage of additional regulation and requirements necessary to make the initial public offering. It is also more costly to raise capital through equity than through debt. And additionally, there is not a tax benefit for equity offerings as there are for taking on debt. Another disadvantage is the dilution effect. Common stockholders have voting rights in the company, and new stockholders will dilute the current stockholders' voting power. So a number of disadvantages listed there. Okay, we don't need to list all of them. If you want to list 2, that's absolutely fine, but we need to make certain that we have one advantage and one disadvantage for each of these methods. So that's common stock. Preferred stock is similar to debt in that it has a dividend, like the coupon payment for bonds, that is paid out before common stock dividends. Preferred stockholders also have rights to assets if the company liquidates before common stockholders but after bondholders. Preferred stock is more expensive than debt but cheaper than common stock. The downside to both preferred stock and common stock is that if dividends are paid, they are not tax deductible like coupon payments for bonds. Okay, just kind of talk a little bit about the characteristics there and how that works as an advantage and disadvantage. The form of raising capital involving debt has the benefit of taking the interest accrued on the debt as a tax deduction. Again, that interest on the debt is tax deductible. By incurring debt and using the interest to reduce taxable income, Mednovation will be able to shield itself from extra taxes and be able to save cash in the form of reduced tax payments. One potential disadvantage is that taking on too much debt may be a negative signal to lenders and investors who may be concerned with Mednovation's ability to pay off this debt. It may show an unfavorable debt-to-equity ratio, which may be used to deny additional loans in the future if it is too heavily weighted regarding debt. Another thing here connected to all of this debt is that it increases the chance that the company won't be able to make the debt payment. The debt payment is a fixed payment, unlike the dividends for common and preferred stock. It is a required payment, and I would probably have put in here the disadvantage of raising debt is the risk of default on the debt, the risk of not being able to pay the debt, the interest on the debt as it's due, and having to make that final payment, that maturity payment, much earlier than anticipated. But that's the third requirement. This takes us then to the fourth requirement, which was the second of our two numerical. We're supposed to calculate Mednovation's weighted average cost of capital, assuming the company decided to raise capital using 25% common, 30% preferred, and 45% bonds. Now, we can just kind of start here by setting up our formula. We're going to take the cost of the common stock and multiply it by 25%. We're going to add to that the cost of the preferred stock multiplied by 30%, and finally the cost of the bonds multiplied by the 45%. Now, in this question, we have to use the costs that we calculated in the second requirement. Here's an example of how when you make a mistake, they don't carry that mistake through to other requirements. So if you got the wrong costs in requirement number 2, when it comes to requirement number 4 and you use those incorrect costs that you calculated in the second step, they're going to assume that those costs are correct. And if you calculate the cost of capital correctly, considering that you used those incorrect numbers, but if you did it correctly with those incorrect numbers, you will get credit for this requirement. So they're not going to penalize you twice if you missed calculating in second requirement. So the cost of the common stock was 20%, the cost of the preferred stock was 16.7%, and the cost of the debt was 9%. So this is if you put the wrong numbers in here because you calculated them incorrectly in step 2, but you do this math correctly, they'll give you points for it. At this point, it's just a math exercise. We get the calculations, we add them all together, and our weighted average cost of capital, assuming this capital structure, is 14%. Okay, good opportunity here to see how this works in terms of a mistake carrying forward into other requirements. So that's the end of the math. We move to the fifth requirement. Define and explain the two types of public offering. Which type of offering can Mednovation use to raise capital through common stock? Well, there are two types of public offerings, the initial public offering and a secondary public offering. The initial public offering refers to a company's first public issue of common stock. Secondary public offering refers to the issuance of new stock for public sale from a company that has already made its initial public offering. Mednovation can use a secondary public offering to raise capital since it already has common stocks trading. So we identified the initial public offering, we talked about the second public offering, and then we said that they can use a secondary public offering because that initial public offering for Mednovation took place whenever it is that they first issued shares to the public. So 5 requirements, 2 were numerical, requiring calculations, 3 were a written response. Again, just make certain you focus on what it is that they're asking about, answer what it is that they're asking about. You don't need to go far afield and write down everything you know about common stock or preferred stock, but make certain that you write when they ask what the advantage is, what the disadvantage is, do the calculations, show your work, and you are absolutely in a position to get however many points it is that are possible on this question. You're ready to get all of those when you answer step by step and just go through and meet the requirements, you'll get all of the points for this question.